I'm here with Daniel and Andrew from Prerequisite Capital Management, and we're talking today about individual equities. This is an expertise that Andrew brings a lot to the table inside of the business, so we're going to talk today about assessing them and how we understand them and gain insight into them.
That's right. Definitely. So just to frame the discussion to kick it off, but previously we talked about equities or the share market at a broader level, like analysing the share market and the prospects for a country. Here we're going to talk about the framework and methodology and just the paradigm and some of the tools around analysing individual companies.
Great.
And so in order to do that, first and foremost, obviously with everything we take basically a systems view or a systems paradigm to looking at any given analysis target in this world, whether it is the world or whether it's commodities or an individual company. The key distinction there with individual companies is that we look at the company through an ecological type lens. So,
right.
and when I say that, it's more like this in a sense of looking at a company as a living system,
right.
like a living organism, and how that interacts and interrelates, etc., with its broader environment. And so we obviously spend a lot of time analysing the macro broader environment, which is pretty good because most individual stocks, the performance is driven 70 to 80% by macro level factors, and it's only the 20-30%-ish of the typical stock's behaviour across the board that is actually more idiosyncratic to that particular
right.
company or industry, roughly speaking.
Right.
So putting the macro aside for a moment, we're just going to talk about a framework for understanding and assessing individual companies within that lens of looking at it as a living system.
So there are some first principles that we need to apply or understand?
Yeah, definitely. I mean, there's three categories of businesses generally. We won't go into this too much. Like at a first principles economic level, it's actually our supply that gives us the ability to basically demand stuff. So that's not a great way of putting it, but at the end of the day, what we can productively produce, if we can produce productive goods and services that people actually want and need and can use, then we have something to trade with other people for their goods and services that they've produced. And in that abundance of increasing goods and services that is within an economic system, that enhances living standards, etc., etc. So that concept of supply creating its own demand is actually an interesting one when you're categorizing individual businesses. So the best businesses have the characteristic of creating supply that almost forces demand. They almost create their own demand.
Right.
They are so good. Right? Now, usually the "they are so good" label only applies for a certain phase of time or
That's
history.
right.
It's rare to find a company that can sustain that over multi-decades. A common popular example of a company that sort of fits into that category is Apple for a small time frame, where they evolved, the iPod, which turned into the iPhone, and all of that sort of series. They sort of front run that whole transition into the smartphone sort of world. And for that period of time, they basically created their own demand, really. And they didn't really have any competitors in those initial phases or the initial years. Different companies have gone through different times in the sun, so to speak, where that supply has created their own demand in a very real, tangible way. Anyway, so there's a second category of companies, and this is probably the majority, 70 to 80% of all companies fit within this category, where it's a much more matured industry or production of goods and services or whatever. And so that's more of a cyclical type analysis framework that you more need to apply. Still pay attention to some of the other aspects. The last category is like just businesses that are basically on their way out, like Kodak, a couple of decades ago, that missed that transition to digital.
Right.
And so that didn't end well, clearly. And so every business fundamentally slots into one of those three categories. Tend to want to avoid the last category, but that main big category, most of this framework tends to apply to.
Yeah.
Obviously, we all want to find those businesses that literally create their own demand.
Yeah.
Right? And we spend a lot of time trying to do that because they tend to succeed irrespective of what happens in the macro environment.
Yeah.
Because of whatever factor, and they have huge bargaining power,
Right.
good margins, revenue growth, the whole works, and it usually will sustain multiple years, etc., depending on the company in question or the product, service, innovation, or whatever.
So some of these companies have preconditions for success. There are some things that are embedded in the companies.
Yeah.
Andrew, what would they be?
Yeah, absolutely. So first and foremost, when we're looking at an ecosystem or the ecological approach to this, we're needing that company to have a real reason to exist. Why are they there? What are they competing on? There needs to be a demand that they are fulfilling if they haven't created their own demand.
Yeah, of course.
They tend not to exist in isolation, and so it kind of leads me to the next point where we need to have a real reason to compete, and on that basis they need to have a competitive advantage or a raft of competitive advantages that are sustainable, durable, you can stand the test of time.
Yeah.
Now, there is a saying out there that the best businesses are those that even an idiot can run. We don't really want to look at those, but we do want to make sure that management is more than capable, they're adequately resourced.
So you look into management when you're...
Yeah, absolutely. So their ability to execute, not just over recent times, but really trying to dig in as much as we can over their career.
Yeah, and their history of allocating capital at different points in time and at different junctures. And sometimes the best thing you can see is a mistake.
That's right.
Yeah, right? How do they respond to the mistake as a team, as a leadership, and all of this sort of stuff?
Because it also then lends to their character as well.
Yeah.
To the extent that you can actually read in.
And how do they lead through tough times and all the rest of it.
That's
right.
right.
It all paints a picture, a three-dimensional picture.
That's great.
Now, so they're the first three. We then move into that business and its position in that ecosystem and its ability to really demand or command respect from the stakeholder groups. Right. And so all those, those stakeholders can be anyone from their suppliers, their customers, their employees, even, government agencies. If they're able to succeed in spite of any of the macro happenings that may occur in the economy, then fantastic. That's the sort of power we're looking for.
Yeah.
Sometimes these businesses can be really just surfing the crest of a macro thematic that will really exacerbate or really outrun the...
Yeah. Well, ideally, it's also a macro thematic that might be around technology or some shift in the way the geopolitical setup is, all basically something a little bit independent to the typical growth, inflation, capital flow drivers of most things. So if we can find something that's moving or it's got tailwinds that's a little bit set apart from the typical cyclical dynamics in different things, that's ideal. And now, although most of these, simple things that we're looking at, they're reasonably conventional, it's a very different thing when you start to apply a systems perspective to actually diagnosing and assessing and developing signal in each of these different realms. Now, some of those things we'll show some practical examples of soon, but that's the basic framework that you key off those few things, and it's the preconditions to possibly a successful investment or a possible allocation of resources into that business.
Yeah. So there's some pillars that exist of your analysis and assessment that are key.
Oh yeah, absolutely. I mean, everything has to be grounded in common sense. It's the most powerful things in this world tend to be the most simple. And even when Andrew was talking about power, like bargaining power, you will tend to have more power in this world, or in an economic sense, to the degree that you're producing really useful, valuable, somewhat innovative and unique solutions to really needed problems.
Yeah.
And so we're looking at it through that sort of a lens. We've earned power, right? We've earned the right to power because of the productive activity that we are pursuing. and the uniqueness, and whatever we're doing that in a sustainably defendable way that others, it's hard for them to replicate.
Yeah.
Right. So that gives us purchasing power. It gives us an ability to even extract cash past the point, because we can argue for better terms, because they need us more than we need them, etc. And it sounds a little bit predatory in the calculus of all of this, but that's kind of the world we live in.
Yeah, that's right.
Right. Now, and so assessing bargaining power type dynamics, especially through a systems lens and interrelationships, interdependencies, and all of the rest of it that come with it, is actually pretty essential. And I'd argue over the next 10, 20 years, especially with the way the world is becoming more competitive, that bargaining power type calculus is going to actually gain even more ascendancy in trying to figure out where to put capital and how not to get left with the bill of a lot of unsustainable issues in the world.
Yeah, that's fantastic, Daniel. Before we move on to some practical examples, Andrew, would you like to just give us an idea of some of the ways in which you might assess risk when approaching these equities?
Basically, we're looking down three dominant avenues. Now, we do need to understand the reality of the situation. I mean, where we are so focused, half the time on the macro environment, that we can, even through some of these tools, be lured into a false sense of security if we haven't done our homework on the intrinsic level.
Yeah.
And so, backing up to that sort of real reason to exist, the competitive advantages, the ability of the management to allocate resources, their power, all those areas, we do need to validate those every day of the week.
Absolutely.
So it's really the intrinsic fundamental analysis that is the first part, and we're looking at the ability for the thing to push out cash flows, generate cash flows. We're looking for the organisation to hopefully be growing, or have that propensity to provide us with positive surprises.
Yeah, great.
We do need to understand the reality of the situation on the ground, so to say. So intrinsic to the organisation, its fundamental reality. So its ability to start generating dependable, predictable, reliable cash flows now and into the future. With any luck, it is growing. It isn't always the case with, especially some of these cyclical companies. They do have their day in the sun, and we do want to be on the front foot when that day is about to dawn. We are wanting to ensure that they're liquid, they're solvent, crying out loud. Yeah. We can get away from this reality sometimes if we focus too much on the macro or some of our indicators that we'll show you shortly. But just a very solid understanding of a lot of the prepositions for success. Really, the balance sheet strength.
I mean, half of this review is trying to assess the reality of the situation. We internally just kind of refer to it as a landmine sweep.
Yeah, that's a great way of saying it.
We're trying to look for contingent liabilities, or Andrew dives into the notes and all sorts of different things to try and find those threads of clues for negative surprises or red flags, or yellow flags, or the rest of it. Because we don't really want to hold something that looks good above the surface, but then have our legs blown off out of the blue as we're walking through green fields.
Potential covenant issues that may occur in light of a macro situation that could be unraveling or unfolding.
Yeah, absolutely.
Just making sure the detail is there. And then thirdly, we are wanting to understand what sort of room to move the organisation has. Now, when we are taking that ecosystem or the ecological approach to, understanding this stock, we know all too well that, left field events can occur.
Yeah.
They can just come in and sideswipe,
positive or negative.
Positive or negative. Yeah.
They need to be able to adapt.
And so really just trying to understand their ability to adapt, what sort of constraints could actually force them into a situation that they can't react appropriately.
Yeah, great.
And really the knock-on effects that a reaction could actually catalyse.
Yeah, and so even this risk assessment sort of summary discussion, the three key pillars of what's the reality of the situation, what's the sort of responsibility of leadership and stewardship, and what's their track record, etc. What sort of room to move do they have, or capacity to adapt positively or negative?
Yeah.
This applies to every area of life, again.
Of course.
You know,
It's
and
insane.
even actually in educating people around sovereign credit risk, so the risk of governments defaulting or printing too much or whatever, the same framework applies. But it really highlights the third element in that, the reality of the situation for most developed world governments is they've promised way too much, they can't fund it. If they accounted for it on a normal accounting principle basis, they're actually insolvent, like already bankrupt. So the reality is they're kind of stuffed, right? Responsibility in terms of leadership, allocation, stewardship, capability, all the rest of it, well, typical government doesn't exactly pass that one with flying colours either. And so it's a fail on the reality, fail on responsibility, which is implying, hey, this could be really risky for most governments at a sovereign debt level. Room to move is where it really gets interesting, right? Now, there's a lot of, at the periphery, a lot of the weaker countries and nations, they have no room to move. They're so hyper-dependent on dollars or this relationship or whatever.
Yeah, that's right, yeah.
They're in trouble. So sovereign credit risk goes through the roof and their currency tanks and the bond markets become, it's the end. The US, for example, especially being the reserve currency issuer and the reserve currency sort of core, they have a lot of room to move. They can do all sorts of things to shaft the bill onto other people or to kick the can down the road and all this sort of stuff. So sovereign credit risk is less of an issue, or at least at the moment. Now, in the years to come, that will likely change. But it's that room to move dynamic, that adaptability, gives them the possibility of being resilient or inflexible, etc. That really starts to underpin that sort of a risk framework. But the same applies in, companies and even people's lives, etc. If you've got more skill and less debt, you've got more room to move.
Yeah, that's so true.
Whatever. The more people the luckier you get, etc., etc.
It doesn't hurt the US government also has fairly decent bargaining power as well.
That's true. That's true.
And aircraft carriers.
So, that's exactly right. So bringing it back to a company level, an equity level, there's obviously some practical examples you can give us of how you firstly assess a company and how this applies.
There is also that step around revelation. We are looking to not be early. So if we're seeing a situation unfold where positive surprises could be occurring for one reason or another, we're wanting to understand within this business what risk it holds that they won't experience the upside to that positive unfolding in that macro.
Yeah, hopefully a little bit before everyone else tends to figure that out.
And,
so that's the revelation step, is when does everyone else become cognizant to that changing reality?
Yeah.
Right, and so the systems interactions and even the systems way of looking at the evolution of financials and that company's activity over time, it will help us see the preconditions and the beginnings of change before a conventional paradigm in analysing financials in that company will see it. And so that's where we get into some of these practical examples of what that actually looks like in reality.
Yeah.
Further to what Daniel was saying, the objective is to identify that marginal shift, that marginal change within a securities reality, just that little bit before everybody else.
Ideally.
And so, all those attributes that we've just spoken about do distill into essentially what is a fingerprint to patterns for success in an ecology or in the ecosystem that we're looking at
of an equity.
So really, it's probably been said in this series before that everything about a business says something about the business.
Yeah.
And so when we're looking at this fingerprint, the pattern to success, we've been able to distill all those aspects into this fingerprint of system success, system strength, ecological viability, and ecological resilience.
Want to give us some practical examples of how this works in assessing an equity?
Yes. So obviously it's that systems context, and so we're trying to assess and identify that marginal shift, but a signal rather than noise, slightly ahead of when others see it, hopefully, is kind of the objective. And so obviously it's a little bit more involved than the simplistic overview we'll run through, but you'll start to see what we mean. So some of the examples will be drawing on BHP, Rio and the CBA, the Commonwealth Bank of Australia. Just some stocks. This framework was evolved more than a decade ago, and so it's a bit old, some of these examples, but it's the same old
Principles.
yeah. And so when it comes to, like Andrew was talking about, bargaining power within an ecology, when you've gone through tough times, so a recessionary environment or a retrenchment in whatever industry or a commodity down cycle, especially when it comes to BHP and Rio, one of the first indications, obviously, of bargaining power returning is just a jump in the intrinsic capability for that business to generate cash. Cash flows, especially operational cash flows and stuff, are more noise than signal most of the time throughout most parts of the cycle. But when you're coming out of like a desert environment, if you can extract more cash out of that broader ecology when there's no water around, no cash around, and then it shows that that ecology really needs what you do, right? And that usually is a foreshadowing of an upswing in that, in the fortunes of that company, and usually a bit after that, profitability kicks in and all of this sort of stuff. It's a bit of a stereotypical rule of thumb, but it's an example of a bargaining power signal sort of metric. And obviously, especially when you take a systems view to how you even measure this stuff using a time series of the company's financials, there's a fair bit of paradox embedded in that, because we're all trained to conventionally look at, a company as a business, and these financials are a snapshot in time. When you start looking at it over time in the evolution of a living organism within a broader context, you start to have to realize some ways of thinking about different line items and their behavior and what they tell us. They kind of have to turn on their head. It's like a fallacy of composition issue. When you get the individual components acting in a certain way, but when you put them all together and they're still acting in that certain way, it's actually the opposite effect that actually prevails. And so this is an example. So that bargaining power metric predicated in this instance around cash flows, but there's a few different ways we measure and triangulate this. When you first get that step up after that tough time sort of period, that's usually the precursor to, better times ahead. And, we get that at the end of 2002, the beginning of 2009. This typically happens in most stocks. So this is Rio's version, and then CBA's equivalent version, usually at the upswing of any cycle. And it's a good indicator of better times to come, and at the tough times, whatever company is kind of weathered that storm. It's usually the buy point, so to speak, if you were to just oversimplify it to a trading strategy or an investing strategy, at which point you actually step back into owning BHP shares or whatever. When we triangulate that so that was the end of 2002, so about there, that translates to here. So we get the buy signal about there. We can see that the sentiment is pretty much completely washed out. Patient money is sort of leading into 03, sort of starting to accumulate, but really accumulates at the beginning of 03. Credit risk is actually moderating. I think we touch on what this credit risk thing is elsewhere. Liquidity is obviously washed out, but in an over-speculative, like a speculative washout, too much pessimism about the prospects of BHP, being accumulated. This starts to paint a picture of, hey, we should be looking at this and potentially gaining exposure. Same with Rio, similar signals. This is end of 2002, we get that decisive signal, same at, what's that?
2009.
Yeah.
Start off.
Right at the sort of the beginning of that up cycle, when we triangulate that with the flows, big accumulation here actually. See, price hasn't finished really bottoming out, right? But we're already getting inherent signs of strength fundamentally. Bit of a washout in speculative interest, pretty significant accumulation. And as see here, 2002, 2003, so washout in liquidity that foreshadowed that weakening, but man, really resurgent and strong and healthy underlying liquidity coming back in. And same here, washout in sentiment, huge accumulation in patient money flows. Credit risk was a bit of a problem, but moderating substantially past the point, especially by the time we got that sort of buy signal indication. Resurgent underlying liquidity, et cetera, Same with the CBA, slightly different metrics to identify and assess that inherent cash generation ability or bargaining power. Like there's other bargaining power metrics that we use and sample. Right. We're not overly reliant on one single indicator, so to speak.
Yeah, great.
It's more of a triangulating process to now what is really going on. You know, similar buy points, similar sort of constructive pitches, obviously no credit risk issues there. Similar story as the BHP Rio. So it all triangulates, builds more confidence and conviction. And on the flip side, like more towards the top of the cycle before a retrenchment, obviously every business exists to produce useful goods and services, hopefully at a profit if it's going to sustain. And so even if it's really successful, it'll be able to, you know, basically grow revenues and earnings and, you know, retain a sustainable degree of demand for whatever they're producing, et cetera, et cetera. And when you take a systems view of how you assess the productivity of that business and those assets and the broader happenings, you get a similar setup in reverse. So when you start to see the moderation of that intrinsic profitability over time, that's usually the yellow or red flags warning that, hey, this is starting to deteriorate in the strength and the prospects. And so that normally typically foreshadows the weakening, you know, fairly decisively in most points. And once again, when you correspond back to the flows again, it's the same, it's just in reverse. So 2001, you know, somewhat over speculative, pretty neutral there, deteriorating credit risk, but only at the margin. Liquidity is actually falling off quite substantially. It's hard to see on this chart, on this scale, but price is rising, but liquidity is actually falling away, and it's a weakening profile. A bit more decisive up here in terms of an over-speculative condition, distribution, you know, ahead of this downswing, which was kind of foreshadowed in the weakening of, you know, the intrinsic profitability and productivity of these assets and that company more generally speaking. Same with Rio, same story, tends to give you a fairly good lead, and because of the system's way of constructing these indicators and triangulating this insight, trying to really get to the core of what drives success and bargaining power and a few other metrics like resiliency, et cetera, we tend to be able to see that marginal shift and get those signals just usually a few quarters ahead of when conventional analysts or market participants tend to cotton on to what's really going on, how that business or that system is actually evolving, because they're looking at it through the wrong paradigm, basically. And so it's a bit of a heads up, and that's why these signals, even though they're based on quarterly data, that and then takes, at the end of the quarter, there's still a month before it's reported typically, we're actually getting very timely signals for stock prices.
Yeah, of course.
You know, which shows that marginal shift in conditions is not being picked up by the broader community of investors and participants around these different securities. And the same applies, this was back obviously a fair while ago, but the same applies today. Same old principles, patterns, and all of this sort of thing.
That's fantastic. Obviously these same principles really do apply, not just at a macro level, but at an individual equity level.
Yeah, absolutely.
It's the same common sense tools, but outworked in different settings.
Yeah, I mean, you can still take the same ecological kind of framework that we've sort of skimmed through, I mean, and apply it to a person, you know.
Or a nation.
Yeah, it's the same old routine, and a lot of these videos and the concepts we're talking about are probably starting to get pretty repetitive, because it's the same principles, just taken very seriously, knit together with a systems
It's great to see, though, how it applies in an individual equity.
And it's also trying to reduce these abstract concepts into practical data-driven tools that,
absolutely.
you know, speak for themselves and are independent of our opinions. It's like, oh wow, you know, that's strengthening again, or, you know, in a fairly decisive way, you know, right at the right time, and, you know, or that's weakening on. That's happening in the context of a fall off in liquidity, you know, marginally over, you know, et cetera, et cetera. Like, it's the same old,
It isn't just a
same
theory,
old.
there's real world application for it.
Yeah, and this
in
is only
markets.
scratching the surface of the tools and the techniques that we've arrayed ourselves with, because it's always trying to get that multitude of perspective through robust independent lenses to see what the underpinning reality is.
That's great.
You know.
Daniel, Andrew, thanks for your time today.
Not a problem.
It's great, guys.